Jackie Lockie, your financial planning maestro. This series of podcasts is aimed at financial planning professionals and also those who are looking to enter the financial planning profession. We will be talking during the podcast about all things certified financial planner certification related, talking to other CFPs around the world, and also we will be dropping in on some new entrants who've just entered the financial planning profession, and we'll be checking up along the way on a regular basis with them to see how they're getting on. I hope you enjoy today's podcast. Hello and welcome. I'm Jackie Lockie, your financial planning maestro. And in today's podcast, we are talking all things assumptions related, a very important topic when building your financial plan for the CFP case study assessment. And I'm joined today by Robert Lockie at Bloomsbury Wealth in London. Welcome, Rob.
Hi there.
And for those who are very perceptive amongst you, you will have noticed that Rob and I have the same surname, don't we?
We do indeed. I wonder why that could be.
And Rob, you were a fellow of the IFP, became a fellow in 1998. By way of background, you've also been the chairman of the education committee of the Institute of Financial Planning as well, back in early 2000s, I think it was. And also, I think what started your infamous or famous journey into assumptions, certainly for the first onlookers, was the article that you wrote for the Institute of Financial Planning's journal, which was all about assumptions and about how to start setting them. And that article proved extremely popular in the CFP fast track courses that the Institute of Financial Planning were running at the time. And your name was kind of up in lights during those courses as somebody who really knew their stuff about assumptions. And then during that time, you've also been a CFP assessor for the case study assessment of the old level 6 with the Institute of Financial Planning. And also you contributed to the IFP Fellows briefing paper on assumptions, which was issued around just after 2010, not long before the IFP started its merger talks with the CISI, which completed in 2015. So you have a bit of history with all things assumptions related, don't you?
It seems that I do, yes. I think it probably grew out of the when I was an assessor for the CFP, and also when I ran training courses for it, we always massively overran on the first section about assumptions when I was running the training courses, and when I was assessing, it seemed to be the area where people had a significant amount of difficulty and often failed because their assumptions were a bit wonky.
Okay, so the aim of the podcast today is to talk about all sorts of wonky assumptions, basically to try and help those going through the CISI Level 7 case study assessment en route to becoming a certified financial planner in the UK. And also we're going to talk a little bit about, towards the end of the podcast, talk about how that rolls out into real life and giving real advice to clients, perhaps using proprietary software or spreadsheets. So let's dive straight in and to get us going, let's talk about why you think we need assumptions when building a financial plan.
Well, I'd first of all say that if you have a functioning crystal ball, you don't need to make assumptions because you know what the future is going to hold, and therefore the need for assumptions disappears entirely. And you may be lucky enough to have one of those, but I don't. So for me anyway, and for most of the people I've encountered, who most of them are smarter than me anyway, they all find that they have to make some sort of assumptions. And it's very simply because the future is unknown and indeed unknowable, and therefore we have to make some guesswork to in order, if we're trying to model anything off into the future, we have to guess about what we think might happen, I guess assumptions is a slightly more credible sounding word for guesswork, but it should be there should be some sound basis behind the assumptions, and they should be kind of educated guesswork rather than wild guesswork.
Yes, absolutely. Educated guesswork. That's just what I was going to say. So, what sort of things would we need to make assumptions about?
Well, broadly speaking, I think we would sort of want to make assumptions about anything which we don't know and which we need in order to project something into the future. So, in the case of a financial plan, there is certain information that is knowable. We can know the current values of somebody's assets. We can know the current value of their expenditure. We can know their current income. We can know what their current family situation is. And there may be some things which they have good reason to expect are going to change. They may be expecting a baby, for example. They may be terminally ill, sort of less promising, but equally that if that's the case, then there'll be some change happening, and we have a reasonable clue as to when that might be, so that kind of thing that we either know or can predict with some reasonable degree of accuracy. We don't need to make assumptions about those, but everything else that we don't know but we'll need in our forward-looking plan that runs for 20, 30, 40, 50 years, whatever, we kind of have to make some assumptions there in order to model what the future might look like.
And I think it's also important to remind people that we aren't just making assumptions for absolutely everything under the sun. We're making assumptions, particularly for the case study assessment. We're making assumptions that are relevant for that client situation, aren't they? So, for example, if the client rents a house, we wouldn't put in the plan an assumption about house price escalation unless it was relevant for something along the way.
Well, indeed, yes. If they're planning to buy a house, then they may want to make provision for what that's going to cost, and therefore including some house price escalation data in the plan would be relevant in their case. I guess probably the ones that have the biggest, or the one that has the biggest impact is undoubtedly the rate at which your expenditure escalates. So it's worth spending some time thinking about that, because over a long period of time, the rate at which you're pulling money out of your plan is going to have a massive impact on the end result. But there's also the rate at which you expect your earned income to increase. It might be that you expect it to go up broadly with price inflation, or you might expect a higher rate, or you might expect, if you're in a career path where the likelihood is that there'll be some substantial increases over time. If you're in one of the professions, for example, then you might want to assume a higher rate. And then maybe a falling rate of increase as you get more established. Yes,
and that reminds me of the story that I used to tell people on the training courses about my chiropractor, and for if he was he was self-employed, he ran his own business, he hired and employed his own staff, he owned a huge building, and was maintaining all of that and everything. So for somebody in that kind of line of work, who's kind of in control of their own destiny, he was putting his prices up by, probably 3 times the amount of inflation at the time, in excess of 10% a year. So I think there are some things, particularly in the case study, when we're looking at it, and actually when we're talking to clients, that they can give us a really good idea, can't they, about obviously what they're not only what their occupations are, but also those future potential enhancements.
Well, typically, yes. That no one has a better idea of what their earnings potential is likely to be than the person who's actually going through that career path, I would think.
Yeah. Great. So, looking at the particular types of assumptions, we're going to have to build a whole raft of different sorts of assumptions set out in our financial plan for the assessment for the level 7. Things like a CPI inflation is given to the candidates at the start, as well as investment rates, cash, fixed interest, equities, that's all predetermined. But then there's still a huge range of potential other assumptions that we would need to make. So let's talk about if there's any, when you're setting assumptions, these extra assumptions that you would need, and actually all the assumptions in real life when you're planning for a real client. Is there any relationship between them, or can you set each one out separately?
Well, I think it's reasonable to conclude that some of them are going to be related. There isn't, unsurprisingly, a huge amount of research that the people seem to have done about assumptions per se, but there is a lot of work that's done on the data that we use to make them. So there is, for example, if you do a search on equity risk premium, you will find a huge amount of material. And the equity risk premium is basically the extra return you expect to receive from investing in equities compared to investing in non-risky assets. So if you hold equities for a long enough period, you expect, because you're taking that risk, you expect to get a return that's higher than if you hadn't taken that risk.
Yeah.
And that's the risk premium. So most, pretty well all assets have a risk premium. All assets that you can invest in have a risk premium, and it may be stable, or it may be rather more wobbly, it typically fluctuates over time. But the longer the data you can look at, the more stable the long-term average becomes.
Okay.
But they're certainly related to each other, because by and large you would not expect to find a situation where over a long period of time interest rates, the return you get from lending money to people, or the return that you pay for borrowing money from people, would be higher than the risk you get from owning a business or a piece of a business, and taking all the risk that business can fail. So you would expect that over a long period, you'd get a higher return from investing in equity than you would from borrowing money, or from lending money rather.
And when we're setting out assumptions, there is that interrelationship. When we're setting down the numbers and thinking it through, that inflation, thinking in terms of inflation plus something can be quite useful, can't it? When you're setting the different other asset classes and looking perhaps at, one of the assumptions you're not given in the case study assessment is one for annuities, or, an annuity stream of income in a generic sense. So then the assumptions that you make are all based on inflation plus that, plus extras, aren't they?
Yeah, that's certainly the approach that we have followed for a couple of decades. So we start off with what we think inflation is going to be, and how we think that interest rates are going to relate to that. Will they be higher or lower? And if so, by how much? Then we look at what sort of return we think we can expect to get from bonds. And then we look at what sort of return we think we get from equities and real estate, and whether we think there'll be any additional premium from investing in riskier things like emerging markets, smaller companies, value stocks. So that enables us to then kind of build up in what we think is a fairly logical way to a series of asset class returns, which which gives us a basis for then constructing what our sort of composite will be for any given portfolio. You mentioned annuity rates. Annuity rates are based on long-term interest rates. So conveniently, if we have made an assumption for interest rates and we're going to use that assumption over the long term of our plan, then we already have a basic starting point for calculating an interest rate for calculating an annuity rate. Obviously, there are various other variables which determine an annuity rate, so the age of the person buying it, whether there's any guarantees, when there's an escalation, etc., etc. But the starting point is what the long-term interest rate is that the issuer of the annuity is using to back it. I think if you come up with a long-term interest rate of 2% and then you decide that your annuity rate is going to be based on an interest rate of 5%, you're probably going to have some explaining to do.
Yeah. It's not reasonable because they're not stacking on top of each other, are they?
They're not consistent. You may be able to come up with a good reason why they should be different, but you probably need to come up with a good reason in order to get that one past the assessors.
Yes, definitely. And talking about reasonable and having a good reason, part of the assessment standards and actually a good methodology for looking at assumptions when in real life, when you're planning for real clients, is also thinking about how they are reasoned, how you explain them, and also if they are reasonable in the kind of round when you're looking at them all, isn't it?
Yes, I think so. But if you can reason something in a logical way, then there's a pretty good chance, as I was told back in the distant past when being trained how to do CFP case study assessments, then it's likely to be reasonable.
So how would you go about setting out an explanation to make it reasonable?
Well, the starting point that we tend to use is that markets are a pretty efficient way of setting setting prices for things, and prices basically then determine returns. So we tend to assume that the market is fairly valued at every time that there is a valuation for it. And that interest rates will kind of follow the same sort of rule, that it's not difficult to conclude that if you look at the data, you can see that interest rates move quite a lot. And it's quite difficult to predict, I think. It's not difficult. It's difficult to predict accurately. You could have looked at interest rates 20 years ago and said, well, okay, that's I think they're pretty stable. I think that's what they'll be going forward. And indeed, government policy has been based on these kind of things. And then you look 20 years later and different things have changed. And I don't think 20 years ago anyone realistically predicted that interest rates would be at under 0.25%.
Yeah.
And with all the implications that has, good and bad.
So your assumptions, they have a historic element, don't they? And then they have a future-looking element to it.
Yeah, we tend to sort of look at. We use a bit of a mixture of the two, really. So we'll start off our inflation assumption. We tend to adopt the approach that the Bank of England has the levers it can pull to, and it has a target for where inflation where it is supposed to be. So we make the assumption that the Bank of England will hit its target in the long term. In the short term, it may not, and indeed frequently it doesn't, because this is an imprecise kind of business. But yes, in the long term, we assume that it will hit its target. Obviously, in the past, inflation has been much higher than this. In the 70s, it was 25% and upwards, but it's also been fairly low for quite a long time. And the difficulty you have, as I've pointed out to many people over the years, You can think you're being cautious if you assume a higher rate of inflation. So say you say, well, the long-term average inflation in the UK, if you go back to 1950 or whatever, the long-term average might be 5%. I'm picking a figure out of thin air.
Yeah.
So you assume 5% going forward rather than the current level, which is sort of 2-3-ish. Then what that's going to mean is that your expenditure is going to be higher than it would be if you assumed a lower rate. And because your expenditure is higher, your assets will show as depleting more quickly.
Yeah.
And potentially in your projection, your estate will deplete more quickly, and therefore you run the risk of running out of resources. And what that leads you to do is either spend less or potentially take more risk. So in the interests of being cautious, you either potentially have a less good life than you maybe could have, or you actually end up, while trying to be cautious, becoming obliged to take more investment risk. So there's no free lunch for these things, and everything is related. So so it's important, I think, to try to get as accurate a number as you can, even though we know that it won't be accurate. And the way to deal with the inevitable inaccuracies of these things is continuous review.
Yes.
Which is unsurprisingly a key part of the CFP process.
Yeah. And you're looking at least an annual review each year, aren't you?
Yeah, I think an annual review seems kind of fairly sensible. Some people's affairs don't change all that much over 2 or 3 years, but as a starting point, I think annual is as good as any.
Yeah. So let's look at the different methods that we could use to create assumptions when we're making financial plans for our clients. There are a number of different approaches that we can use, aren't there? So just run us through broadly 2 or 3 different types.
Well, yeah, the simplest by a considerable margin is what we can call deterministic or linear assumptions. Whereby we come up with a set of numbers from looking at our prediction for whatever our starting point is. So we use our prediction for inflation, only we don't have to predict it. We steal the Bank of England's target. And then we add on risk premia based on generally some historic, as far back as we can go, some historic data for risk premia for the various asset classes we own. And then we tend to knock a bit off just in the interests of caution, I guess. Despite what I just said about if you take too much off the assumptions, then it makes it then you can end up with somebody running out of money on the projections. But we'd rather project somebody running out of money than project them not running out of money and then they do. So that's the simplest one, and you just apply those rates of return and those inflation measures to all of the variables you have going forwards, and you end up with a nice line showing the value of someone's income and expenditure, and another one showing the value of their assets over time, and it goes up or it goes down, or more commonly, it does a bit of both.
Okay.
So that's very simple, but it has the obvious drawback that the reality is that if you assume a rate of return of X every year, you probably won't get that return every year. And in fact, I have seen research that people have done where they've looked at that over a 30, 40 year period where there is actual data. And the average return of whatever asset class it was they were measuring over that period, there was no single year in which it actually matched that long-term average.
Yeah, and
that's the data that was producing the long-term average. So you assume a return of 6%, or rather, you look at historic data which shows a return of 6% average over over that period, there's a pretty good chance that there will be no single year within it which had a 6% return.
Yeah.
So that's the obvious drawback to using deterministic assumptions, that they will be wrong. But I think, certainly in our experience of dealing with clients, clients pretty well understand that you're modelling and it's going to be wrong. If they can't manage to grasp that, then maybe you need to be spending a bit of time explaining to them why that is. So that's the simplest method, but obviously it has flaws. And I suppose the other main one that people use is, there's two other main ones which are kind of similar to each other. One is bootstrapping, whereby you take a load of historic returns on a kind of monthly basis, maybe. And if you look at 30 years, let's say, then you've got 360 monthly returns. And obviously those 360 monthly returns occurred in a certain order.
Yep.
Although if you chart them, they will look like the proverbial drunken man wandering down the street, because there will be very probably very little in the way of obvious pattern to them. So by bootstrapping, you take each of those 360 months and you kind of, if you imagine getting 360 bits of paper, writing the return of 1 month on each one of them, chucking them all into a box, and then pulling them out one at a time and putting them down in order, you end up with 360 months in a completely different order.
Yes.
And that will give you an idea of one of the potential outcomes that you might have had. And it was probably just as likely as the one that did happen.
Yeah.
But if you do that exercise multiple times, then you'll get a spread of possible returns that you might get, or you might have had, rather, assuming the next 30 years have the same monthly returns as the last ones. So it gives you a measure of the spread of how things might be different.
Might have been different.
Or might have been different, indeed, yes, because the future has no, markets and things like that have no memory.
No.
So the future could be completely different. If you'd done that exercise in 1917 in Russia, looking at the previous 30 years, you might have been a bit surprised if you expected the next 30 years to look anything like that.
Yeah.
Because clearly they didn't.
No. And then there's my favourite name, which
yes,
is Monte Carlo, isn't it?
Yeah, indeed. So Monte Carlo simulation gives a similar kind of range of outputs. I guess it's called, I believe it's called Monte Carlo because someone with time on their hands thought it was a bit like kind of multiple spins of the roulette wheel at Monte Carlo. But intriguingly, it wasn't dreamed up by an academic in the casino in the Principality. It actually arose from the Manhattan Project, which was the project, as those with a penchant for history will recall, was the project to design the atomic bomb in World War II. And what the scientists who were building the bomb were trying to do was to find a way of simulating multiple possible series of events that could happen when they were looking at the whole fission experiment. And so Monte Carlo is basically a way of taking a number of variables, which would be an average or an expected, in investment terms, it will be an expected return, so a mean return, a standard deviation of that return, and if you're looking at multiple variables, as you tend to be with investment, then some kind of correlation coefficient, and then you then, by applying these things to a piece of software, you can end up with a kind of thing that looks like a distribution chart, and it will give you an idea of what returns you might expect based on that data.
Yeah, a kind of range, isn't it?
It's a range, yes, exactly. And that's all jolly good because, once again, it shows you that there's a pretty wide range of possibilities that could happen. Someone did this with I mentioned the Bank of England's efforts to keep interest rates at a certain level. Someone did it a while back with to look at the Bank of England's efforts to control inflation and how accurate their predictions for future inflation were. Looking forward, not all that long, only I think it was about something like 3 years. So not a terribly long period. And bear in mind the smart people they have in the Bank of England, it turned out that they were within about 90% of getting it accurate most of the time.
Wow.
But they weren't terribly close to the target line that they were aiming at. So even with something where it's fairly short term and where you're not dealing with lots and lots of variables, it doesn't necessarily give you that much more accuracy.
No.
And I often think of these things when people sort of promote them to me as it's kind of like you do your financial plan projection, and at the end of it you can say to you can look at the end position and say to the client, well, probably when you get to age 90, you'll be somewhere between living in a cardboard box and living in a mansion. But I can't tell you which of those is more likely, because they're all equally likely, according to this. Yeah. You'll probably be somewhere in the middle. And it may be that actually none of these paths turns out to be correct.
Yes.
And I, personally, while it's valid for explaining how uncertain everything is, I don't think it's hugely helpful when the client next says, okay, so what should I do?
Yes. And that's the thing. That's what they say. They say things like, well, that's why I engage you. That's why I pay you to give me advice on what to do next that would, maximize my chances of getting the outcome that I want.
Yes. And there's always a lot of variables, but there's always also a limited number of levers that the client can pull. Yeah. Which are typically limited to spend less, save more, take more risk. That covers most of them, really. Earn more.
Yeah, a bit of everything.
Yeah, exactly, or a bit of all of those. But you don't want to be. I'm pretty confident you don't want to be in a position of saying to a client, well, because the worst case is pretty grim, you probably need to get a second job, work weekends, spend nothing, and put all your money in emerging markets warrant funds or something.
Cross your fingers.
Exactly.
They'll probably say because bye.
and also stop paying our fees, because that's just money that's going out, and if it's not going out, then it's accumulating in your bank account rather than keeping me going. So it's not necessarily terribly practical to do that, I would say.
No. Okay, let's move on to another interesting topic, and something that we've seen in the past, being assessors, the pair of us, it's taken people quite a long time to kind of bend their heads around the impact and the differences between nominal rates of return and real rates of return. Because I think in the past we've said, well, it's pretty simple, the explanation, but it's actually the impact of the difference between the two, I think, that really matters. So just give us a quick rundown of what is nominal returns and what are real rates of return.
Okay, well, I think it is pretty simple, actually. Nominal returns are the return that you get in terms of cash. So if you put your money in the bank and you can find a bank that pays you 1% a year, and you put in £1 at the end of the year, you'll get back £1 and a penny. And that's you can take that penny and you can wave it around and say, this is the interest I have earned, and it is 1%.
Yeah.
And that applies obviously to other things like, this is my house, and my house costs £100,000. It's gone up 1%, so at the end of the year, it's now worth it's now worth £101,000. No, it's worth £110,000. One should always use a calculator.
And real rates of return?
So real rates of return are they start with the nominal return, but they take account of what you can actually buy with it. So typically, you would then apply an adjustment for what the rate of price inflation is at the time. So if, for example, you manage to get a return of 5% on your investments, so that's all jolly good. And at the end of the year, you can cash them in, and you can wave the 5% around that you've earned and say that's great. But inflation might have been 2%, and therefore all of the things you might buy with your 5% have actually gone up in price.
Yeah.
And because they have gone up in price by 2%, you now can't buy £105 worth of stuff that you might have bought last year. You can only buy £103 worth of the £100 of stuff that you could have bought a year ago and had £5 left over will now cost you 102, so you only have £3 left over.
Yeah. Or in some situations, because it's that buying power, isn't it, that is the most important. So when clients say, I want to retire on, an income of, £30,000 or whatever it might be, £40,000, retiring at 55, they mean buying power of 40,000, don't they? Because it's what they could buy today to cover their expenditure.
I think in almost all cases, that's exactly what they think. And in fact, typically when people say they want an income of X, they don't really mean they want an income of X. What they mean is they want an expenditure of X.
Yeah.
Because while people accept that it may be necessary to pay taxes, they don't necessarily see paying taxes as part of their objective.
No.
So if they say I want an income of 30,000, and they actually mean I want expenditure of 30,000, if they could have 30,000 without paying any tax on it at all, they'd probably be quite happy with that.
Yeah. Okay.
But yes, they mean they want to spend that, and it's very much more difficult for somebody to predict what expenditure they're going to want to have in 30 years' time, without comparing it to what they spend now. And if they spend 30,000 a year now, and they don't expect their lifestyle to change materially over the next 30 years, then it's pretty straightforward for them to be able to say, well, I want the same lifestyle, so let's assume that's 30,000. I can, if I can buy this many things for £30,000 today, I want to be able to buy the same things.
Yes.
In 30 years.
Same buying power. And how does that impact when we're doing projections for clients, that looking at the real rate of return, because it's one thing understanding, that kind of one nominal is kind of including inflation. It is the face value. The real rates of return is effectively the buying power, the kind of net of inflation along the way. But then how does that actually shake out when we start looking at projections for, retirement? What does it do to the numbers actually in the spreadsheets that we might create for our financial plan assessment?
Well, if you have basically two ways you can do it. If you were building your own calculations, you can either do all of the calculations in nominal terms and then apply a discounting to each value to allow for inflation, which will work as long as your maths is correct. But you you kind of run the risk that it, apart from the fact that it's a load of extra work, and extra work that's unproductive is kind of a bit pointless, really, with my business owner hat on. It also adds risk because you're creating the risk of making errors, and the more steps you have in your calculations, and then the more difficult it is to spot those errors, and potentially you could be making them for a long time.
Yeah.
So I've always held the view that it's much easier to do your apply your inflation adjustments at the start, and then use real rates of return and any other measure that you're using to discount the rate before you start messing around doing the projections.
Yeah, and I think it's
so that would apply not just to investment return, but it would apply to, for example, if you're planning to assume a rate of earnings inflation that's higher than prices, or you're planning to you're expecting to employ a rate of expenditure escalation that's higher than general prices, then you adjust everything by your price inflation assumption. So you will see basically the line will be less steep for all of those measures once you adjust for inflation.
Yeah.
So instead of going up at quite a steep angle, if you're assuming a return that's substantially above inflation, once you apply inflation, then something that goes up exactly with inflation will be a flat line across the chart, and everything else goes up by the amount, according to the amount by which it exceeds inflation.
And using real rates of return for a client in real client situations can be very beneficial, isn't it? Because like your £30,000 a year expenditure requirement for when your client retires, you were just talking about a moment ago, in a spreadsheet, once you get you do all your projections, then actually what falls out the bottom, the client can actually see that is the buying power of £30,000 net of tax, net of charges, net of inflation, at the time that they want it. So it kind of it's a bit more user friendly for the client as well, I think, isn't it?
Undoubtedly, yes. It is much easier to explain. I think back in the distant past, when the mandated projections that the regulator required companies to produce were all in nominal terms, you would see these telephone numbers come out at the end. Oh, whoopee-doo, your pension will be worth £850,000, or fund will be worth £850,000. But that was 40 years ahead, and it didn't really tell you anything about whether you were funding it as to the extent that you needed to meet your objectives. Because what it didn't tell you was, well, by then your expenditure could be £200,000 a year.
Yes. And
your pension fund's only 4 times your yearly expenditure, so that might not be enough.
Not going to last you very long in that situation.
So it was. I think it's undoubtedly a good thing in planning to work in real terms. It makes it much easier for everybody involved, and if you're consistent with it, then you don't have to kind of remember each time you look at it, oh, now is this real or nominal?
Yes.
Because you know that they're always real.
Yeah. And I think also if you use nominal rates of return, you've got quite an explanation for the client, haven't you? Because basically you've got to say, well, actually, I know that you've said you've told me you want £30,000 of expenditure, when you retire in however many decades it is. But actually £30,000 isn't that. It is whatever it might be, £56,940,000 and 20p. So therefore I'm actually targeting that, even though it feels to the client it would be easier for them to say, well, I want 30,000, and then to be able to look, if they wanted to, into the tables and go, oh yes, there's my 30,000.
Indeed, yes.
Yes, it can get that complicated conversation, isn't it?
Oh yeah, and it's bear in mind that you typically with a client you may only see them for 2 or 3 hours a year at their annual review meeting, and so you want to make sure that you get, or they get, the messages from that you want them to get.
Yeah.
And ideally, if they say they want a certain level of income or a certain level of expenditure to be met, and you can show them that number being met, they will go away happy and comfortable, rather than if you show them that actually they need a lot more than that, but that looks okay as well.
Yes.
You can't control what they remember.
No.
And the danger is that they'll remember the wrong thing.
Yeah. So finally, let's talk about, we started to talk about what happens when you see real clients as opposed to doing the, level 7 case study assessment. Many financial planners are starting to use cash flow software, maybe in a combination or instead of, traditionally we might have used Excel spreadsheets in the past. And just give us a rough rundown on what the situation is with assumptions in these proprietary software systems, if they're pre-populated, and whether you can use the ones that are inside those systems, or whether you should be setting your own.
Well, I'm not familiar with all of the tools by any means, but I know my way around enough of the one that we use. And I looked at a couple of others when we were considering what to buy to replace the spreadsheet-based tool that we used ourselves for some years. As far as I know, the regulator has never kind of specified anything about what rates of return you have to use. They do produce a handy, or they commission, I think PwC actually does the legwork for it, they commission a handy piece of research every few years on projection rates, and you can find those on the FCA's website, and that's quite useful. Not I don't recommend it because it's something that the regulator produced and therefore you have to follow it, but just that it gives you some numbers and some methodology, and therefore it's a useful contribution to the thought on the subject. But there's no obligation to use particular rates of return, and there's no obligation to use particular rates of inflation or any other assumptions. They are up to the practitioner which ones they select. But from the perspective of if you're a senior manager in a business where you have a liability for the work that is produced, and potentially you may have to go and defend something in court, then I think I would just feel a lot more comfortable if I knew that everyone in the firm was using the same set of assumptions, at least as a default. Clearly, they may be varied by individual clients, particularly for things like earnings expenditure, or earnings inflation for that particular client, and expenditure inflation for that particular client. But as a starting point, I would be much happier if I knew that everyone in the firm was using the same set of assumptions, and that set of assumptions had been agreed throughout the business as being a reasonable starting point. Because I think you're creating a whole lot of risk if you let people do their own thing, and make up their own numbers as they go. You also, we have a situation periodically, where somebody goes on holiday, and one of the clients with which they deal, which they principally deal, needs to have a meeting. It is going to create a lot more work if you look through their plan before the meeting, knowing that it's a client you're not familiar with, and you discover that the assumptions that have been used in their plan are ones which you completely wouldn't use yourself. And then you're faced with going into a meeting, and when they say, well, why did you use that? You have to explain something that you don't agree with.
Yeah.
So that's a bit tricky. And I think that's that exactly the same applies to you buy yourself a piece of software, and in order to help the users, it comes with a set of assumptions preloaded. And those assumptions, someone or some group of people who may or may not work for the company that produced the software, that's a set of assumptions that they've come up with. And you may or may not be told what their thought process was. And I have seen some where I was sent a document to explain what the thought process was, and it was a thought process that I personally thought was a pretty unsound, because it used, I think, where they couldn't get any long-term data for a particular type of asset, they took the last 10 years and said, well, we'll just assume that that's repeated for the next 10 and the next 10 and the next 10 and the next 10 years. I would be nervous of using that assumption in a plan. And I think you would certainly open yourselves up to a risk of losing a case if you had to go and defend that. And imagine you had to defend it when you only just found out when the other side's counsel brought it up that was the method they used.
Yes.
So although the software that we use has a set of default assumptions, we look at each one of them and we accept or reject them according to whether they are coincident with the numbers that we've come up with using our methodology. Because I'd be happy to stand up and defend our method, and I'd be less happy to stand up and defend a method that I had no input to.
No. Yeah. Okay. Great. Thank you. I think we've been rabbiting away for nearly an hour now, so I think we better stop there. But Rob, thanks very much for your pearls of wisdom and sharing some of your expertise on assumptions. I'm sure that many of the people going through their level 7 case study assessment, and actually those who have already done it and are CFP professionals themselves, will have gained some real insights into perhaps going back and reviewing what they do in their businesses as regards to assumptions after our discussions today. So thanks very much for joining me.
Not at all. Thank you for the invitation, and I hope it was of use to somebody who was listening.
I hope you enjoyed today's podcast. It's quite interesting to listen to the different views and discussions with different people, isn't it? Join me next time when we'll be discussing all things certified financial planner related and catching up with those new to the financial planning profession. Bye for now.